So we think the recent pullback we've largely seen has less to do with China's intervention in the metal markets, but it has more to do with the trajectory of the US dollar. Ever since we saw the Fed take a lot more hawkish tone at the last meeting, we've seen a bit of strengthening of the US dollar, and I think that is putting a lot of pressure on the commodity markets. And I believe we still believe the dollar is likely to weaken in the growth story globally. And so that demand for safe haven dollars should be weak going forward. And the other key thing that's going to bring the dollar down is, the twin deficit that looms largely in the US.
Let me ask you then about this European recovery that we're watching, because the stock market is a little bit lackluster. We keep on hearing that fund managers are inclined to put more money to work in the cyclicals in Europe. But if you look at the trade, it's been so stop-start over the past couple of weeks, and playing catch-up to the United States seems a little bit challenging for European markets. Is it happening, and when is it going to happen?
So, at WisdomTree, the way we're viewing the second phase of the recovery for European equities are really based around the reopening trade. So far, we've seen Europe actually benefit from the manufacturing recovery that's been spurred from China's recovery, from China being the first economy to actually bounce back. What we believe is going to be the second phase is the consumer coming back. For developed markets, the consumer sector remains key, and we believe we're already seeing signs of consumption, consumer confidence, a consumption recovery take place within the services sector, and services account for nearly 70% of Europe's GDP. And I think that's going to be the key catalyst going forward for Europe. Regarding the catch-up trade, I've always lost out on this catch-up trade because we've always been saying Europe will catch up to the US. I think they're both very different markets. And I think right now the reason why Europe is doing so well is because it's more of a value play. So the reopening trade was very much linked to the fact that value sectors such as financials, industrials, materials, those segments of the economy to benefit from high inflation. Those would be the sectors that would do well, and that's what's really benefited Europe. The US continues to be one of the strongest performing markets because of the rise of the technology sector, and that's where they have a dominance globally. So I would say that it's very I've soon realized after many years of comparing Europe to the US that it's an unfair comparison. They're both very different markets. They're also very different in terms of size and in terms of the amount of the size of their stock markets versus GDP. So I believe this phase of the recovery is very much attuned to Europe, and Europe will pick up at this phase.